Hi everyone, I'm back in Brooklyn. I just got in from London yesterday, and on Sunday we were talking about Delta Airlines CEO. Maybe crowing is not the right word, but things are good for airlines right now. It's all packed. And the guy's saying basically that there's a lot of marginal decision making where people are prioritizing air travel at the moment, which is kind of interesting. He's also expecting a continued growing strength in business travel. And so the outlook there is pretty good. And of course, oil's been good for the past couple of weeks. One thing we would caution is that the dollar has weakened a lot in that period, but others would argue that the dollar oil link is less strong now because of all the efforts that are being made by Russia, China, Venezuela, I guess. That sort of multipolar world not to use the dollar as much for energy. Fact is that the majority of global energy is still traded in dollars, and as a result of a weakening dollar, you would expect a strong oil price, and we got that, which is not to underestimate the fundamentals here, other than it's midsummer. So in July, you're going to get strong US gasoline demand relative to winter, go figure. The US refineries are going to run hard, which is what they're doing essentially. And that means you have strong demand. And the thing to watch out for is whether we can sustain oil, firstly, to break through the 200-day moving average, which we haven't done. And that looks like a kind of a ceiling for the moment. We'll see if we can make a sustained break above the sort of 82.5 Brent level that would be about the 200-day now. And if we do, that could signal a higher level for oil with a real resounding success for Saudi and Russia in forcing the oil price higher. Or alternatively, we kind of fail here and it becomes a problem because you put the whole bag in on bullish stuff. If you've got Saudi cuts, potentially Russia cuts, good US demand, strong jet fuel demand, and some better data from China as well, to be fair, over the past week or so, which would all tend to indicate that we may be maxing out here on oil. The classic seasonal trade, barring external factors, would be to short oil on Labor Day and stay short into February. That's the classic seasonal trade. External factors can change that. But, the kind of thing that you'd need to see there would be a massive surprise to the upside in Chinese economic performance. Maybe just like the no-landing US economy is always a possibility, I guess, but difficult to believe with the Fed needing to pull down inflation an awful long way from here and likely to raise rates again. I was noting, credit card APRs right now, if you've got debt on a credit card, it's 22% annually, which is just brutal. I feel terrible for people who have a lot of credit card debt because it's just going to get bigger and bigger, unfortunately, with that kind of an interest rate. So credit card spending is quite clearly slowing. People are still planning on paying for airline tickets, but generally speaking, the expectation is once we get past summer demand peak, and this will be about as good as it gets in oil markets, you'll then be into a downtrend, a typical seasonal downtrend into February of next year, and we're targeting 60 essentially, let's say January 31st next year. So who knows, we'll see. Earnings for Halliburton tomorrow. Kinder always sets us off. Kinder should be uncontroversial. Halliburton always sort of slightly beats by a couple of pennies here or there and gives an outrageously bullish outlook, which never quite shows up in the earnings. And you've seen actually stock multiple expansion has been the theme there. Typically Halliburton then underperforms out of earnings, so watch out for that one. And then we are concerned for the US E&P results. Exxon had a pretty rough profit warning, which is kind of bad for everything, but essentially means you're probably going to see some weak gas performance. For sure you will, because Fang Diamondback also had some rough guidance on their quarter in terms of gas realizations. So the E&P results may well be problematic. And we're going to be very heavily dependent on the oil price continuing to go up. If it can break through the 200-day moving average and make a new band higher, then the oils will continue to do well. If we fail at that 200-day and stay in this range, I think you'll see them run a bit here with the oil service results and then roll over. One of the problems for us in the oil service results, which is actually bullish oil, is that you are seeing a significant reduction in activity in the US particularly, and of course that becomes a problem for Halliburton, but I'm sure they won't portray it somehow that way on their call, but essentially we are seeing a significant rollover in the rig count, which also it raises questions of US inventory, and if we're running out of US inventory, that becomes very bullish global oil, because as you all know, the major marginal difference in global oil supply between 90 million barrels a day and the current 102 million barrels a day of demand that we currently have over the past 10 years has been very much met by US production growth. So once that production growth begins to falter and fall away, you become very dependent on some pretty dodgy places for growth. with the arguable exception of actually some Western Hemisphere names, which obviously would be Canada and Guyana. Although, of course, we had a major accident in Mexico, which further undermines the confidence in Mexican sustained production levels. So we'll see. At the moment, oil's doing well with a weakening dollar at peak demand in summer, and the stocks are enjoying it. Unless we get some major additional external help post-Labor Day, which would be strong China, maybe more Saudi cuts. I can't imagine they can cut more, though. Maybe some horrific outage. Maybe you lose 1 million from Libya. You know, any one of a number of things can happen. But all things being equal, we'll fade away from this, you know, good run that we've had over the past couple of weeks once we get to Labor Day. So our recommendation is enjoy it while it lasts, because we think that while the market will kind of enjoy the oil service results prints over the next 2 or 3 days, it always tends to fade those results, and then we'll get into the E&P results, which, notwithstanding some special situations like Hess, where they're doing extremely well and have really none of the issues that the rest of the industry has, Hess and Exxon both, of course, enjoying their leverage to Guyana. Once we get into the E&P results, it could turn pretty rough. Okay, have a great week.